Headline economic data currently suggests a healthy, normalized environment. With real GDP rising at a 2% annualized pace, the economy has cleared what was historically considered the stall speed for a recession. This aggregate data seems to support the continuous advance of the equity markets, which have recently pushed to record all-time highs. But the last 6 months show that beneath the 2% average, the underlying metrics have begun to sharply diverge. While GDP appears stable, non-farm job creation has nearly stalled, growing at an annualized pace of only 0.1%. During this same window, the overall U.S. labor force actually contracted at an annualized pace of 0.8%. These conflicting figures suggest that the headline growth rate is being driven by a force separate from the broader labor market, creating a fracture in traditional economic benchmarks. Understanding this divide requires analyzing the U.S. as a bust-booming economy, split between two distinct cohorts. The first cohort is a hyper-concentrated segment the data refers to as New Era investment. This segment is defined specifically as business investment in information processing equipment and intellectual property products. The second cohort is the Old Era sector. This represents the remaining 87% of the economy, the segment responsible for the vast majority of U.S. jobs. Because these two sectors are moving in opposite directions, blended aggregate data can obscure the reality facing individual investors and policymakers. This chart tracks the share of U.S. GDP comprised by information processing and intellectual property. From just 3% in 1990, it underwent a multi-decade expansion, doubling during the 2009 bull market and reaching 13.2%. Although 13% is a minority share, with speed of its growth now allows it to mathematically dominate the broader economic averages. This polarization marks the culmination of a 35-year structural shift that has finally reached a critical mass. The severity of this shift is most visible over the last 6 quarters, where the structural divide triggered an acute divergence. We map this divergence by comparing cumulative growth starting in late 2022. The red line shows information processing investment surging at 7.9%. The blue line represents the 87% majority, stalled at an anemic 1.1%. These specific trajectories translate directly to the equity market. Technology and AI-linked sectors follow this 7.9% growth vector, while traditional broad market equities remain anchored to the flat line. The lack of breadth in the S&P 500 serves as a direct reflection of the concentration of growth within the real economy. Tech-heavy indices are outperforming because they represent the only segment of the economy experiencing actual expansion, while the majority of the economy sits at the edge of a recession. This data maps directly to the psychological state of the American consumer and the long-term trend in sentiment. This chart compares the real growth differential between these sectors against the University of Michigan Consumer Confidence Index. As the economic divide widened, consumer confidence collapsed in tandem. Most Americans derive their livelihoods from the 87% old-era economy, which has remained largely stagnant while the tech sector booms. Current consumer sentiment aligns with the reality of an economy where most participants are excluded from the primary source of growth. Policymakers are currently caught in a trap created by the disproportionate share of gains originating from this narrow tech boom. Historically, investment in IP and information technology has accounted for a growing share of the total real GDP gains during bull markets. In the current cycle, a staggering 28% of all economic growth is being generated by this single 13% sliver of the economy. This concentration complicates the work of the Federal Reserve, which relies on aggregate headline data to set monetary policy. At the same time, current inflation is largely driven by supply-side geopolitical conflicts rather than a broad overheating of the national economy. Restrictive monetary policy intended to cool the aggregate economy fails to address these supply-side pressures, while actively straining the 87% of the economy that is already struggling. The U.S. economy is currently defined by a profound imbalance. A small, high-growth sector is essentially dragging the weight of the remaining 87%. Investors have the ability to adapt by overweighting the specific sectors experiencing this growth. Traditional corporations and the broader labor force lack that same structural flexibility. Without a shift in policy to accommodate the broader economy, the divergence between record-breaking indices and the recessionary reality of the majority will likely continue.